investing on margin, many of us get nervous just by thinking about it. Still, many of us are investing with borrowed money, maybe without even realizing it. Because if you have a mortgage and at the same time are investing money, then you're actually borrowing to invest, even if not with the investment portfolio as a collateral, but the house instead. In this video, we're gonna talk about the pros and cons of investing on margin. And to be completely transparent, I'm not investing on margin myself. And as usual, there's no one answer fits all. There's a mathematically best way and a psychologically best way, and they're not always the same. First, I will explain how it works to invest on margin. So the more money you're investing, the more you will get when the stock market goes up. I mean, if you have 1,000 invested and the stock market rises by 10%, then your return is 100. If you instead had 10,000 invested and the stock market went up 10%, well, then you will have gotten 1,000 in returns. So the more money invested gives a higher return in, for example, dollars. Then if you increase your buying power with the help of a loan, then you will get a higher return in absolute currency, but also in a higher percentage return as you're leveraging your own capital with the borrowed money. Well, this is in case the stock market goes up, of course, because if it goes down, you will lose more. Let's say that you have a portfolio valued 7,500 and you want to borrow 25% on this so that your total sum ends up at 10,000. Now let's see what happens to the investments with and without the loan if the stock market rises with 10%. In a portfolio without the loan, your capital will rise to 8,250 as you get 750 in returns. In the margin portfolio, the sum will instead increase with 1,000 to a total of 11,000. This means that you will get a higher return on your own capital because your own capital was still 7,500 with and without the loan, and then an increase of 1,000 on this capital means that you will get a 13.3% return on your investment instead of 10% as the portfolio without the loan got. This is a bit simplified, of course, because you also have to subtract the interest rates on the loan as a cost, of course. Okay, so this seems all fine and dandy, but, and this is a big but, the same thing happens when the stock market goes down. So let's see what happens if the stock market instead goes down by 10%. Yeah, well then the portfolio without the loan would end up at 6,750 as you would have lost 750 in the decline, while the portfolio with the loan would end up at 9,000 as it would have lost 10,000. And this is not the loan going away. It never does unless you pay it off, of course. This is your own capital decreasing to 6,500 compared to 6,750 without the loan. So this means that both ups and downs gets amplified when you're investing on margin. Okay, so if you want to invest on margin, you have to understand how it works to invest with leverage, and that this means that your own capital can both increase and decrease more than the general stock market. Usually you can borrow up to 50% against your portfolio. This means that you have doubled your purchasing power. If your stocks decrease and your own capital falls below 30 to 35% of the total portfolio, the exact number is depending on the brokerage, then you get the dreaded margin call. This is when the brokerage contacts you to tell you that either you have to increase your own capital in the margin account or sell off some assets to meet the minimum requirements. If you're only borrowing 10%, the stock market would have to decline by 86% before you only have 30% of your own capital left. But if you have borrowed 50%, it only takes a 29% decline before you're reaching the minimum requirements. So what you really need to consider is not just how the stock market have performed end of the year historically, but also to consider intra-year drawdowns, because even if a year ends on plus, about every second year or so, we see an intra-year drawdown of at least 10%. Here we have calculated what this looked like for the S&P 500 between 1991 and 2019. So the green bars represent the stock market end of year performance, while the blue bars represent the maximum intra-year drawdown. And as you can see, in more than 50% of the years, we see a drawdown of 10% or more. And in about 13% of the years, we see a drawdown of 20% or more, even though some more years were very close to 20. So the worst year was of course 2008, when the intra-year drawdown was 48.8%, and the stock market finally ended up at only -37 in the end of the year. And if you look over this whole period and not just intra-year, the worst drawdown was 56.8%. a pretty substantial drop, especially if you're investing on margin. So you really need to consider this. Would your portfolio survive these drawdowns? This is what you also need to consider. If you want to invest on margin, invest long term to lower the risk. And don't borrow too much. You certainly don't have to borrow 50%, even if you can. And remember that the interest rates have to be lower than the returns you get for this to even make sense. If the portfolio value has declined too much, you can be forced to sell your investments if you have fallen below the minimum equity requirements. And most importantly, it's possible to entirely wipe out your own capital and part of the loan so that you will owe money to the brokerage if the decline happens very rapidly, so you don't have time to sell earlier. I mean, if you only invest with your own money, you can only lose 100%, everything, but you will not owe anything afterwards. And it's pretty unbelievable that you will actually lose 100% of your money unless you are investing everything in just one stock. But if you're investing on margin, if things go bad, you might lose all of your own capital and then parts of the loan as well. Then you have zero own capital left and you owe money to the brokerage that you cannot pay back even if you sell everything. But as the brokerage doesn't want to lose money, this is not likely to happen unless the decline is exceptionally fast, long before you will get the margin call, and the brokerage will ask you to either add more money or sell off and pay back some of the loan to lower the borrowed percentage. Instead of trying to get the higher returns on your investment by taking a higher risk, maybe through investing in a very concentrated portfolio with just a few stocks or in a single industry or even penny stocks, it's actually often better and less risky to invest in a broad and diversified portfolio with less volatility and then increase the returns by investing on margin. It also makes more sense to invest on margin when you're young and still have time to rebuild your savings if they would be wiped out in a crash. If you do it right and invest long term, you can actually lower the long term risk by investing on margin, even though you're raising the short term risk in this way. Does this sound illogical? Let me explain. When we're young, we often first of all have less money to invest. The salaries are often lower and the expenses might be higher if you're just starting a family or trying to buy your first home. And you probably know that compound interest will work for you with time, and the more money you have invested, the more they will grow because of this effect. So when we're young and doesn't have that much money to invest and not that much already invested either, the capital will grow slower, and then when we're older and already have accumulated some capital, it will grow faster. And hopefully by then we also have a higher salary with the possibility to contribute more towards our investments. In addition, the longer time we invest, the more we will lower the risk of not getting back what we put in, the risk of losing money, because the longer time we invest, the closer we should get to the average returns of the stock market. So by investing on margin when we're young, we can expose ourselves more to the risk of the stock market earlier and more long term, so we can lower the long term risk and get higher returns. Then, when we get old, we can gradually decrease the loan. I mean, without the loan, the invested money would grow exponentially with contributions and compound interest. Then the returns of the stock market in the later years would have much higher effect on the portfolio than what happens in earlier days, as it will increase or decrease the absolute value more. If you instead invested on margin and then gradually lower the percentage of the loan, then the effect of the stock market on the portfolio value could be more smoothened out, and not as much risk would be attributed to the later years anymore. And this is exactly what we're doing when we're buying a home. Rather than waiting to buy a home until we've saved up the entire sum, that might be several hundred thousands, we're using a mortgage so that we can buy now and don't have to wait until we're 50 years old to move out of our parents' home. A win-win situation for both kids and parents, I would say. You could say that we're borrowing from our future selves, as the loan are based on our future incomes, and that we're going to be able to gradually pay off the loan in the future. And here we're willing to take on huge leverage. We might get off with a down payment of 5% or less. Imagine investing in stocks like this on margin with only 5% own capital and then borrowing 20 times that. It would of course be very risky and absolutely don't do this, but I just want to illustrate the difference. That we're willing to take so much leverage when buying a home, but often none at all when investing in stocks. At the same time, maybe we're not using all of our income to pay off our mortgage, but instead we take part of it and invest into the stock market instead. Well, then we're de facto investing with borrowed money. And this is of course smart when interest rates are low and the expected return of the stock market are higher than these. The researchers Ayres and Nalebuff suggested an investment strategy with 4 phases to save more money for retirement or to be able to retire earlier. And the most important thing here is that this is a long-term strategy. The first phase includes investing 4% of your income and then investing on margin with 50% borrowed until you reach the first milestone. Here they're actually assuming that the whole portfolio could be wiped out in a stock market crash, but as this is so early, it will not matter and you will end up with more than the person that didn't borrow anyway when they investigated how this portfolio would have performed between 1871 and 2004. So when reaching the first milestone, then you should gradually decrease the borrowed amount while maintaining the milestone sum. I mean, if the milestone sum was 100,000 for example, and the stock market goes up by 10% for 1 year, then the portfolio value will increase to 110,000. Then you take the extra 10,000 and pay down the loan a bit, and then you keep doing this until the loan is completely paid off. Then in phase 3, you stay invested with 100% in stocks but no loan and let your own capital grow. And then finally in phase 4, when approaching retirement, then you should start to gradually decrease the exposure to stocks to 50% in the end. In this way, you go from a 200 exposure to a 50% exposure to stocks. And with this, you have diversified the risk more over time. They explain it like this. You're not diversified if you buy stock A for 100, stock B for 200 and stock C for 300. Stock C will have 3 times higher the weight in your portfolio compared to stock A. Instead, you should be better off by investing the same amount of 200 in all 3 stocks. This would have lowered your risk. And the same goes for an investment over time. If you have 100 invested in year 1, 200 in year 2 and 300 in year 3, then more weight would be put on the stock market in the 3rd year. It would have been better of course if you could have invested 200 each year. You could do this by investing on margin with 50% borrowed money in year 1, pay off the loan during year 2 with this year's earnings, and then only invest 2/3 of your own money in the 3rd year. But finally, it does come down to the psychological aspects if you should invest on margin or not. So start by asking yourself if you want to take even more risk than the risk you are exposing yourself to when you have 100% invested in stocks without the loan. There's a good reason why the average investor's returns are much lower than the stock market average, and this is because we make stupid mistakes like panic selling in the middle of a crash or trying to time the market. If you know that you have a hard time just staying invested long term without panicking, for example during a market crash, then investing on margin probably isn't for you. And then there's more to life than money, of course. I mean, you shouldn't worry to death as soon as the market turns red a day and not be able to sleep at night. These are telltale signs that you have exposed yourself to too much risk, even if this might be the mathematically smartest thing to do in your situation. If you're considering investing on margin, be careful. Don't borrow too much and read up on this beforehand so that you're absolutely sure on what this means, and don't base everything on a random YouTube video. It's a completely different thing to be there in the middle of a crash than to see some numbers on a paper and think that I can handle this just fine. Is investing on margin a good idea, or is it downright stupid? Share your thoughts with me in the comments. I'm looking forward to hearing what you think and talk to you there. And don't forget to subscribe so that you don't miss out on my upcoming content about stocks, personal finance, and how the stock market really works, because I can't really afford to miss it. Thank you so much for watching all the way to the end, and see you all next time.